All right. Welcome, everyone. Hold on. Let me just hit record on the Zoom. All right. Welcome, everyone, to this week's Sunday macro wrap up for Sunday, September 7th. We had a pretty interesting week last week with a little bit of a spike of volatility towards the end on Friday there from the jobs report. We're going to get into some of the jobs numbers as well as put a cap on the data that we got for the labor market. And then we're going to be taking a look at some of the data that's coming up this week. Pretty interesting stuff. There's a lot of whipsaws going on right now with recession fears. And then this week, we have inflation reaccelerating. So, it'll be interesting to see how the market reacts. I mean, you have bond yields near the top end of their trading ranges, or I'm sorry, near the low end of the trading ranges. And so we could see some more bond volatility continue from here. But let's go ahead and get into this here. Let me know if you guys can hear me. I know last Sunday we were having some audio issues, so I want to make sure that everyone can hear me all right. Looks like it's good. All right, coming in there. Perfect, perfect. All right, so as we know, the market had a little bit of a freak out there with the jobs market data last week. Pretty much all last week it was interpreted as bad, which there's definitely a softening going on right now. There's no doubt about it. But I think that the changes in the jobs market are more structural than cyclical, and we're going to get into that data right here. So just to recap, as you can see, the non-farm payrolls number that added only 73,000 jobs. Oh wait, actually, let me refresh this. This should show August here. All right, so there you go, 22,000. So pretty weak numbers, right? And so we still need to also see the revisions that happened. Also, too, we have the unemployment rate rising to 4.3%. That's the highest, I believe, since the pandemic, or at least 2021 when it was coming down. So that was really the whole freak out last week. And so just a reminder, the formula for the unemployment rate is the total amount of unemployed people divided by the total labor force. And the labor force is just the total amount of unemployed people plus the employed people, right? And then also, too, when we take a look at what the BLS considers the labor force, they have the labor force bucket as well as people not in the labor force. And that's important for later on. We're going to be taking a look at the reason why we're having structural issues with the labor market, not so much cyclical. And that's important because what investors are suggesting right now with this recession fears, as well as what the bond market is signaling, is that there's a huge crack or a crisis level mode happening in the labor market, which, there is some labor softening, but again, I don't think it's due for a full freak out here. So let's just go ahead and go through some of my notes here. So what's interesting is that when you look at the weekly initial claims report, right? So this is the amount of unemployment claims that come through every single week. And as you can see, it's pretty much, we haven't seen huge spikes in initial claims, right, for unemployment. Those are pretty much the same as pre-pandemic levels, right around like 200,000. So you're not seeing any spike in initial unemployment claims. Also, as well, when you look at total hiring has continued to fall off, right? So jobs aren't hiring. Quits are also very low. So jobs aren't hiring, and people also aren't leaving their jobs because the labor market is so tight. But also, too, again, when you look at this is another data point on top of the initial claims data. When you take a look at layoffs are not having a surge as well. And so the typical turning points in the labor market when they get really bad is when you start to see layoffs start to really accelerate, which we're not seeing just yet. Also, as well, when we take a look at the labor force participation rate, you can see, if we can zoom in here, that over the past 3 months since April, this has had a very large drop off, and it's broken this structural zone around 62%. Or 62.5%, and now it's around the lower 62 percentage points, right? So that's definitely interesting, seeing the labor force participation rate drop off. And also, as well, when we take a look at the total employment to population ratio in the United States, that has also started to come down, right? So if we look at the change in percent from 1 year ago, you can see that the employment to population ratio has been negative since March of 2024 and has remained negative. It hasn't gone back to positive, meaning that there's more people just moving out of the labor force, right? These can be people who are retired, as well as some people who you'll see in a little bit how the current administration's immigration policies have also been, not to get political, but they have been drawing on these numbers as well in terms of creating a tighter labor market, right? Just looking at numbers. Again, not trying to get political here. Now, what's interesting is that if you look at some of these components of the unemployment level, you can see that people who are losing their jobs, yes, they have been increasing, but it's around 3,400. This is still pretty similar to pre-GFC, as well as pretty much the same levels from November 2016 and in 2017 as well. So we're not seeing a huge spike in job losers for the unemployment level. If we look at job losers as a percentage of the total unemployed, you can see that this number has actually been decreasing. So most people are electing to either just take themselves out of the labor market in general, right? Again, we're not seeing a huge spike in the percent of job losers as a percentage of total employed, right? So usually during recessions, you see this number spike here. We're not seeing that right now. Again, this is another metric to look at, job losers on layoff as a percentage of total unemployed. So again, this goes back to the layoff data. We're not seeing huge spikes there. Now, what's interesting is that going back to these buckets here, you can see how there's the employed, unemployed, and not in the labor force. Whenever you see the unemployment rate go up, that is because there are employed people going from the employed bucket to the unemployed bucket and still remaining technically in the labor force. And so when we take a look at some of these flows here from the employed to the unemployed bucket, we are still remaining within, the comfortable zone, right? Within like 1,300 to 1,500 people. That's pretty much the norm from the pre-pandemic average, right? And then when we look at the flows from the unemployed bucket to not in the labor force, well, that number has actually been accelerating quite dramatically, right? So going back to the buckets here, we're seeing people go from the unemployed bucket to the not in the labor force bucket. So these are people who are no longer looking for a job for 4 weeks or less, right? So they're not actively looking. Not sure what they're doing, but these could be people who have just given up on trying to look for a job, and I'm not sure how they're surviving, but that number has been increasing. And I'm not saying that this is like good news for the labor market. I'm saying that these are structural downturns, not necessarily the cyclical downturns that we've been seeing in past cycles. This is something that's different here. When we take a look at the labor force flows from not in the labor force to employed, we've actually seen a spike in that recently, right? So people who are not in the labor force have actually gone into the employed market. And then when we take a look at the employment level of foreign-born people, foreign-born, so people who are in the labor force in the United States that were not born in the United States, right? So, this goes towards the immigration policy. Look what's happened really since January of 2025. This has just been in free fall now, and it is actually negative year over year for the first time since the pandemic. So that right there, see how this is negative for foreign-born employees? That's actually a direct result of the current administration's immigration policies, right? While in contrast, native-born, so people who were born in the United States, that has actually started to accelerate here, right? So we're now at, this past month was 22,762 people added or no, I'm sorry, that's in the millions. So 2.7 million people native born were added to the employment level versus, and that was the highest really since November of 2023. So yeah, this bottomed in November of 2024, and so native born employment levels have actually been rising. So that's definitely interesting. And then, as we know, this is kind of the more structural, long-term, trends that are going on. But the birth rate in the United States has been plummeting, pretty much for the past, 15 years or so since the Great Financial Crisis. And so it's a combination of all these different things. You have employers not hiring, but they're also not laying off people because they've seen from the pandemic that it's incredibly hard to find talent. And, that was a big pain point for for businesses who had to rehire people after the fact, right? Because they lost a lot of important people. So there's a real disincentive for businesses to just lay off people in a high rate right now, but they're also not hiring. You also have, we just saw a lot of the native born employment has gone down dramatically, right? So you're no longer getting that fluff, that increase in number from foreign born employment levels. And then you're seeing a lot of people just take themselves out of the labor force entirely. And so they're not even being calculated in the entire employment level, BLS numbers that come out every single month. And so all this to say, as well as when you look at seniors in the labor markets, a lot of them are retiring, right? So you're getting retirement, all those things that we just talked about. And so when you see this number here, when the economy adds 22,000 jobs, this could be the norm from now on. We could just see structurally lower jobs numbers going from here, where it's not necessarily, just people firing, right? It's just that there's a huge labor freeze right now. And we're also seeing a shrinking population, more retiring, less foreign-born jobs, all the things that we just talked about. And so this is a structural downturn. And I'm not sure if rate cuts would solve this problem. I'm sure they would help, but really it's a supply issue. It's not a demand issue on the job side, right? And this is something, again, that cannot be necessarily fixed with rate cuts. And so it's definitely interesting seeing that, but that's what my thoughts are with the jobs market. And it's this chart right here that can pretty much sum up the problems that are happening. So these are people who are not in the labor force that still want a job, who are just not finding work, right? And that number has increased, which again, maybe those people would be wanting to try and get back into the labor force and look for jobs if rates were cut and there was more hiring going on. Maybe that's the play there. But it is interesting because we haven't seen something like this in quite some time. But all this to say is that this supply issue for employment is suppressing the unemployment rate, right? So when we take a look at this formula here, both the numerator and the denominator are having outflows at the same rate, which doesn't change or barely changes the unemployment rate number. All right, we beat that horse to death. Now let's move on to some of the other metrics that we saw last week with the ISM manufacturing PMI. Slight acceleration, still in contraction. Manufacturing is a large leading indicator of the economy. What's interesting is that you had a huge spike in new orders, which could be at a first glance, interpreted as a positive data point, which it is. But a lot of these manufacturers, if you go into the actual report there, a lot of them are getting ahead of these, tariffs that are still lingering on, heading into the holiday season here coming up in the next couple months, right? So a lot of these manufacturers are putting in, a lot of new orders ahead of the holiday season as they anticipate prices to keep going up. So again, that's taking future demand away. While manufacturing prices paid still remains pretty elevated here, right? Still not as high as 2021 and 2022, but still accelerating. And then what was also interesting is that ISM Services PMI, which to me, in my view, and in the team's view, this is the most important leading economic indicator for the economy because, again, services, you guys have heard me say this before, services makes up over 70% of the GDP number. And so, you really want to take a look and pay attention to services. And that did have a decent 1 month acceleration back into expansionary territory or, farther into expansionary territory, but also, too, um, it is interesting seeing the comment being that this was led by an increase in tariff or an increase from the tariff impacts with indication of business activity and imports being driven in an attempt to get ahead of additional price increases while preparing for the holiday peak season. So right there, right? So this could be an artificial 1 month pump, which really it's still below, pretty much the levels from the past, 6 months from last year. All right. Yeah, so new orders had a decent acceleration. Prices paid still remains, at very high levels here. So that also continues to accelerate, which goes into the stagflationary environment, which is what brings us to this week, right? So um, we have producer prices on Wednesday, September 10th, and then on Thursday we have the consumer price index. And as of right now, we have the consumer price index. Let me see. It's at 2.7% year over year, still higher than the pre-pandemic average. And then core CPI is at 3.0%. So remember, if you remember last month, it was a unexpectedly higher acceleration. Well, if we take a look at the what's being priced into this month, they have headline CPI. This is the Cleveland Fed's inflation nowcast. They have it going from 2.7% to 2.8%, so an acceleration, and then core CPI remaining at 3.0%. So they're not showing any relief really in consumer prices for August. But then interestingly, they have headline CPI going up to 2.9%. Right, so a third consecutive monthly acceleration, and then they have core CPI coming down to 2.9%. So, still, even after the September print, which the September print gets reported in October, that's still going to be 2 months of sticky inflation, while the Fed is cutting rates into that. And so this is a very difficult environment to navigate here for the Fed, obviously, because again, a lot of these problems are structural problems that are still the after effect of the shutdown of the economy during the pandemic. A lot of people, for some reason, are forgetting that we shut down the economy, and the central banks. It took them from their creation in 1913 to 2020, it took them, over 100 years to get from zero to a $4 trillion balance sheet, 100 years. And then in a single month in March of 2020, they doubled that to 8 trillion. So they did 100 years of damage, $4 trillion in 1 month in March of 2020. So of course that's going to have some lasting issues for probably decades to come from now, right? And so you're just having a lot of these things clash, and I think that I don't think we're ever going back to the pre-pandemic norm, just because things are just fundamentally changing right now as we speak. And then I don't know I don't have the chart in front of me right now, but I'm not sure if you guys saw the unemployment rate for new graduates from colleges. So early 20s kids graduating from college, the unemployment rate is at a record high right now, around like 10%. So, if you have, the older generation retiring, you have the younger generation completely discouraged, you're going to have some societal problems from that, right? Meanwhile, all of this is going on as well. So, I think that all of this to say is that we're going to have structurally higher inflation, maybe not, as crazy as the inflation that we saw a couple of years ago, but maybe 3% is the new norm because of the tight labor market, as well as the slowing population, the more the higher efficiency from AI technology and stuff like that. Maybe this is just the norm, but we're clearly not in the same environment from the pre-pandemic, and I don't think we're going back. Taking a look at the yield curve here, this is the current yield curve in blue, as well as we have in green from 3 months ago, and then in red from 6 months ago. As you can see, the short end of the curve, which is the bond market trying to price in Fed policy, so monetary policy, rate cuts. As you can see, that's dropped pretty decently, about 40 to almost 50 basis points. While the long end of the curve, which is the bond market pricing in future growth and inflation expectations, right? It's not really with government or Fed policy. That has actually remained structurally higher, which could be an indication of inflation remaining stickier. And so, yeah, this Nike checkmark logo swoosh, that's not necessarily a healthy yield curve, right? This bode. So that's definitely interesting there. We're continuing to see a steepening of the yield curve there. Taking a look at the charts here, we had the S&P 500 have a decent, drawdown on Friday. Still, on Thursday, it made new all-time highs. And, despite all the negativity, despite all the weakness, the market is still trying to front run a lot of these rate cuts, and it's optimistic about that. So, there's nothing really, stopping this bull trend right now. And, it's going to remain bullish until it goes bearish. Not sure when that is, not sure what price that is. There's not really a point in trying to guess what that timing and number is. You just want to remain invested in it as it remains in bullish trend. And if it breaks trend, then, get rid of it. Go on to the next thing. Obviously, too, what's interesting is gold continues to surge. So last week we had a huge move in gold. It broke through its this price level here, $3,430 per ounce. This has been a continued retest since the end of April, and it finally broke through it on August 20 or no September 2nd there. So had a huge gold breakout, and that in and of itself is a huge sign of stagflation, right? Because gold does really well in stagflationary condition sets. Bitcoin, interestingly too, it has weakened and remains pretty much near the low end of the trading range here. But Bitcoin is also an interesting signal because we all know that Bitcoin is very liquidity sensitive. So central bank liquidity, that is, and when you take a look at central bank liquidity, that continues to drop here. And that's mainly due to the RRP, so the reverse repo facility. That's pretty much out of money at $21 billion. And then the Treasury, in their Treasury General account, their goal is to get this to $850 billion by the end of September, and they're currently at $662 billion. And so for them getting to $850 billion, they would have to increase this by whatever that arithmetic is, like another 180 billion or so. And so that's going to be a negative for liquidity because the Treasury General account is a liability on the Fed's balance sheet. And so when this goes up, that means liquidity is being drained. And then also, too, you're seeing a drop off in bank reserves. So you're just getting a double negative there while the RRP is drained. So when it comes to central bank liquidity, this has been, dropping, and it looks like a pretty similar chart to Bitcoin here. So if that continues down, I wouldn't be surprised if I wouldn't be surprised if we continue to see headwinds for Bitcoin there. What's interesting is that, going into this week, if we do, or when we do get accelerating inflation, we'll see if the bond market has a rally, as we've been talking about before. The United States 10-year U.S. government bond yield is, pretty much the most important chart that I'm looking at right now. And so, we've been talking about over the past several months since November about the stagflationary ping pong. And that has been the 10-year going from, or bouncing from 4.2% all the way up to 4.5%, and actually just broke through it, which could be a signal that inflation might be slowing, in the months of November and December and, forward. One thing that I also look at is the 5-year break-even inflation rate, and that also, just broke down. And so after the September print with inflation, you could start to see that coming down at least, which would be positive for the inflation front. But if it goes down too quickly, then that can be interpreted as a recession signal. So interesting there. But when you take a look at the target rate probabilities for the Fed meeting on September 17th, which is in a couple weeks, not this week coming up, but the following week, there is now a 92% chance that they're going to cut by at least 25 basis points. And actually, after the labor market data, there is now a small percent chance that they'll cut by 50 basis points. So we'll see how this changes as we get the inflation number. Maybe we'll get this back to 98% with a 1% chance of a pause. But I think that this will flip again, once we get the higher inflation numbers. But we are coming up at around 8:30. For those who are joining on our live stream, the Sunday macro wrap-ups are typically an hour or an hour and 15 minutes. And the first 30 minutes is always streamed on our social media pages. The second half is only for our Macro Optics members. And so if you want to join the discussion offline, there are some links below where you can start your 7-day free trial of our macro investing community. And once we log off here, we'll talk about some actual ideas that are on our list so that we can take all this information that we just talked about and put it towards our portfolios there. So we're going to go ahead and close it out there, and we'll see you on the offline portion. But for those who are on the Zoom call, stick around. Let me just close out on the streams here. Bye, everyone.